welcome and thank you so much for coming tonight. And when I looked at the weather report this morning and it was 92 degrees on the way down here, I was happy we didn't decide to try and do an outdoor event this time. And this is a new location for us, and so far I've gotten some nice feedback. Everybody seems to like this location. Maybe a little bit difficult getting in here, but certainly a great spot. Before I begin, I'd like to thank my staff, and Mike had talked about Brad, and I want to give them a special thanks this year because since January when we were together, we had a long winter internally. And it was our first season, as you know, bringing tax season internal to 1015. And although we didn't get through without any hiccups at all, we had a couple of them, it was truly an all hands on deck. And I want to thank you guys for your patience and working through the first year with us. And we're really excited. We're going to be rolling out some new technology during tax season this year, some new and exciting things. So as your advisors are going to be talking to you in the last 2 quarters, they're going to be talking to you about some enhancements that we're working on for tax season, which will be wonderful. Brad did a great job, and we're excited about some of the new things there. Andrew and Evan have been working on a project for 2 years, and we're just about finished up, and we'll be rolling out some new performance reports in the second half this year, which we're really excited about. And it's hard to believe, but Lomax, Brian L., the other Brian, he's been here with us a year already. And he's really taken a head seat at the portfolio management table. And let's just say it, the performance speaks for itself. And so he's been a great addition and really brought some great depth to the company. And so all of this, when I talk about some of the updates, and we're bringing in some other people as well, we drive every year with one goal in mind: to bring exceptional service and what we want to consider second to none in client services. So all the new things that we have that we're working on, that's our goal for you. And so we're going to continue to work on that. And so we have a great presentation put together tonight. So I hope you enjoy it, and we'll walk you through, and hopefully you'll walk away this evening with a little bit of understanding of some of the things that have been going on out there in the market. All right, for those of you that are new, we have a regular agenda that we're going to follow. So we're going to talk about where we were, where we are, and where we're going. We'll spend some time at the end talking about what we'll be looking at in the second half of this year. But before we begin, as most of you know who've participated before, we like to start the evening by kind of just getting your minds going a little bit. To just take you away from you've had some drinks and had some food, and just get your mind going before we get into the major content of tonight's program. So think of this as those things that are most often Googled. How often do people look certain things up? So in this category, sharks don't get cancer, Vikings wore helmets with horns, or Napoleon was short. The most Googled within that category is Napoleon was short. Over 33 million people wanted to find out. He was actually 5'7" tall, and at that time was actually pretty tall. The next category is don't swim after eating a meal, bats are blind, or caffeine will dehydrate you. Well, 7 million people wanted to find out if it was okay to swim after eating, and the answer is yes, just so long as you hadn't consumed some alcoholic beverages with that dinner. The next category, it takes 7 years to digest gum. Not sure where it would be for 7 years. Adding salt to water makes it boil more quickly, or Salieri hated Mozart. Well, 11 million people wanted to know that when you boil water, it in fact does not make it boil faster, that salt does not make it boil faster. And our last topic for the evening before we move into the presentation, bulls hate red, the 5-second rule, or goldfish have 3-second memory spans. Would you believe that 96 million people wanted to check out the 5-second rule? It really doesn't have anything to do with how long it's on the floor. It's about the cleanliness of the floor that it falls on. So, that being said, let's get into the presentation this evening. And you know, we could put it at, my goodness, how much has the world changed just since December when we were together? My how goodness, how everything has changed just since the end of May till right now. But oh my goodness, look at how different a decade has made things. Back in June of 2009, the S&P 500 was at 900. It closed over 3,000 for the first time last week, setting new record highs or 3 times higher than it was just 10 years ago. The economy was a whole lot different back then as well. Back in 2009, the unemployment rate was averaging about 9.5%. We're down to 3.6 today. The highest income earners back in 2009, wages, average salaries for the highest earners, 171. They're up to 222 today, or a 30% increase in income. Unfortunately, for the lowest earners in our country, their salaries were at 11, now at 13, which is only a 15% increase. We're going to talk tonight about some of the disparities in the wealth gap out there. And the median price of a home has gone from $182,000 to $267,000, which is a 46% increase. And I referenced this in my last commentary in talking about kids coming out of college today in a really strong and robust jobs market, but wages haven't kept up with the price of housing. So the affordability issue is still out there and alive and well in our economy today. The Wall Street Journal reported that net worth for the US hit an all-time high at the end of the first quarter. We're up to $108 trillion, offsetting the decline that we saw at the end of the last quarter of 2018. The disparity, however, again, is becoming more and more evident. And if you took this graph and overlaid it with that market graph, it starts to explain where these numbers diverge. For middle America, the 40 to 70% group, that orange line, just the one from the bottom, net worth has increased over the last 20 years by an average of only 1% over the inflation rate. For higher net worth people, it's been 3 times that amount. But look where the graph starts to diverge. Post the financial crisis, post 2007. And remember that chart that I just showed you of the stock market. It's the wealthier households that hold the stocks and have benefited from the upsurge that we've seen in the stock market, hasn't helped. And the combination of lower wages and higher costs is making it more and more difficult for the middle class. And if you believe that a strong economy is based on a vibrant and well-abled middle class, it is something that we're going to have to address going forward in our society today. But the combination of higher costs of healthcare, higher costs of housing, and higher costs of education is making it more and more difficult today for the middle class than any other time to reach the financial security that the middle class has enjoyed for decades behind us. We're seeing it evident in the millennial generation. And I think this is really significant because if the younger generation is already starting out behind the 8 ball, it's going to make it more and more difficult for them to catch up. The average 35-year-old today, their net worth is approximately 34% below where a 35-year-old net worth would have been in 1994. That's a big difference. If you've had your money in the stock market, 2019 has definitely been a positive to your net worth. This year, we started out, the first half of 2019 is the best start to the year since 1995. There's a couple things I want to point out on this graph here. The first bold line, and again, it breaks out different types of asset classes, the S&P 500, some of the world indexes. The first dark blue line is the performance of that asset class in the first quarter. The light blue line is the performance in the second quarter. So obviously the first quarter was a lot stronger than the second quarter. We started to see some of those headwinds rise again in the second quarter, but obviously the combination of the first and second quarter has been spectacular across many asset classes. What I'll tell you is the surprise is the very middle of that graph. The very middle, you see those two equal length bars. That chart is representative of the performance of the US corporate bond index, showing strong performance in both the first quarter and the second quarter. And for us, and again, we manage mainly balanced portfolios, people who are retired. And to have your stock portfolio working right alongside your bond portfolio doing well at the same time, not a bad thing to happen at all, right? And it's certainly a surprise. And those of you who have been with us for a number of years understand the concept. When interest rates fall, bond prices go up. And I think that's the surprise that 2019 has brought to us. This chart here shows you the 10-year Treasury rates in the US as well as other parts of the world. And you can see exactly as we transition, the very back end of that graph, as we transition from 18 into 19, interest rates literally plunge. Now, those of you who are together with us in January, we talked about the Fed coming to the rescue in early January. January 2nd, the Federal Reserve came out and said, I think we're close to neutral. We're no longer going to continue to raise rates. By February, it was pretty much built in that they're going to actually start to cut rates, so that psychology of the Fed, peak rates behind us, lots of money floods into the bond market, driving prices higher and yields lower. I want you to look at the bottom part of that graph. That's the interest rates in Germany and Japan. And we've brought up this topic before, but it's continuing to cause lots of issues in how interest rates around the world are combined together. German interest rates this year, or the first part of this year, hit record lows, minus 0.41%. Now, how does this work? I mean, when you think about the interest rate environment, and it has a lot to do with demand. So let's say I would like to borrow some money, and I canvass the room here, and I only find one lonely soul. I'll say, Anthony was back there, nice enough, and he's going to lend me some money. So he and I are going to negotiate that rate. He has pricing power, right? He's the only guy in the room who wants to lend me money. So he can set the rate pretty high because he's the only guy around. Let's say now the tables change and I would like to borrow some money. And everybody here in the room is lined up to lend me some money. What do you think happens to that rate? It goes down. Competition. Lots of money. And we've got money flooding into the US from all over the world, wanting to buy our treasuries at the paltry 2% that they're offering because there's no better rates anywhere else. And it certainly is causing, and again, think about portfolio managers. Going into December of 2018, portfolio managers were largely positioned on the assumption that the Federal Reserve was going to keep raising rates. So what are you going to do? You're going to wait, you're going to hold your cash so that sometime in 2019 I'll buy those bonds because I'm going to buy them at a much better rate in 2019. Well, lo and behold, the Fed shifts gears, he's now in reverse. Portfolio managers are scrambling to get money put to work in the bond market because the high rates are now behind us, they're not in front of us. So that demand continues to push rates lower. And this has significant implications on a lot of things that go on out there. So what it's caused in the United States, because rates on the long end have been driven down, we've got a very unusual situation. We talked about this in January, but it's become much more prevalent. So the blue line there is representative of the yield curve in 2009. It was normal. Short rates, 1 month, 3 month rates, 0.17, 0.19. But then if you want to go borrow money for a mortgage at 10 years or 20 years, you're going to pay 3.5%. That's a normal yield curve. That orange dotted line, that's the yield curve, June of 2019. So here's the problem. See those short rates, 218? You go down to your local bank, you deposit your money, what do you expect the banker to pay you? Short-term rates. Now I walk into the bank and I'm looking to borrow that money. I want to borrow some money. I expect to pay the long-term rate. How much money do you think the bank wants to lend under those circumstances? Not very much. So the Fed has kind of boxed himself into a corner because they raised interest rates consecutively, and then we have this new transparency out there that they're going to tell us all about what they're going to do. So now the market has pushed those long-term rates down on the assumption that the Fed's going to cut. He has to cut. You got to bring that short rate down to start to fix the interest rate curve. So these things start to have major implications in the market. What does an inverted yield curve tell us? It typically tells us that the economy is going to slow down and we're heading into a recession. Do we know that it's telling us that today? No. No, it's not as clear. It is certainly a question, and you got to read all the tea leaves. But people look at the interest rate curve, say, oh my God, we're going into a recession. But if you understand the demand dynamics out there and the amount of money that's floating around, it maybe is not telling us that, at least yet. So JP Morgan released this study recently. And you know, with all this confusion in the market, look, we went through a 10% correction in December. Couldn't explain really what had changed. We went through a 5% correction in May. Nothing had really changed. So you go through these periods of volatility and what happens? People get nervous and they make bad decisions. These type of charts have floated around, and I thought it's a really good time to drive this point home. So what this is telling us, if you had invested in the S&P 500 20 years ago, just left your money in the S&P 500 for 20 years, you would have averaged 7.2% per year. Not so bad, right? If you got nervous somewhere along the line and decided to pull your money out because things didn't look all that calm out there to you, if you missed just the 10 best days, 10, your rate of return would drop in half. That's over 20 years. And if you had missed just 20 of the best days, your rate of return would have gone from 720 down to about 1%. So who do we need to make sure what do we need to make sure we're watching out for? Ourselves. That we can be destructive of our own returns. And ironically, we don't know why, but big up days seem to be clustered really close together with big down days. So you get out thinking you're going to avoid the downside, and what happens? You miss the upside. The better way to handling this is making sure that you're properly diversified. And this really speaks to our philosophy about how we manage money. So I think it's really important to point it out at times like this where we're sitting at these market highs and everybody's questioning, well, what do we do now? This chart looks a little confusing, but I'm going to walk you through it and hopefully drive the point home. The first set of bars there, that is a diversified portfolio. Portfolio made up of 70% stocks and 30% bonds. The stocks are diversified and the bonds are diversified. The first bar there said it's at 4%, and it's what we call the excess return. Well, what's that? That's the rate of return you would have made over the risk-free rate. So the difference of putting your money in a savings account versus having your money sit in a diversified portfolio. So 4% per year above the risk-free rate. Not so bad, right? The second line there tells you the standard deviation, or what I'll really refer to as the volatility of your portfolio. Volatility about 10%. So what if you decided to put 100% of your money in the Russell 2000? That's the green bars. You would have increased your rate of return, your excess return, from 4% to 6%. That's a 50% greater rate of return. And over 20 years, that's a lot of excess return. That's a lot of compounding of interest. Look at the second bar, your volatility. Twice as much. How many people can feel comfortable trading in for a 50% better rate of return for 2 times the amount of volatility? Will you get through those rough days? Will you stay invested? Or will you be the center of your own demise by not being able to handle that volatility? It's a big question investors need to ask. And I really want to look at the middle line there, the yellow line. It's the S&P 500. There's an awful lot of talk these days about passive investing. The index is up over the last 10 years. Just throw your money in the S&P 500 and you'll be fine. You're going to make money each and every year. Well, look at the rate of return on the diversified portfolio versus the S&P 500. Basically a dead heat. Look at the volatility. Much higher. So again, when we look at how to manage money and how to protect our investors during periods of volatility and periods of significant uncertainty about the world around us, making sure that we're highly diversified and you've got assets that are working at all different times, and making sure we don't reach that point where people don't want to stay invested. A really significant thing to keep in mind. So why are we talking about this? Volatility has been non-existent. We talked about it in 17, lowest volatility year I think that we've had on record. Still continue to see low volatility, but it's starting to creep up. So you want to make sure you're doing that gut check. Are you properly diversified? Are you able to handle the volatility? And make sure that things are the way that you're going to be comfortable as volatility picks up. So who do we credit a lot of this to, or maybe discredit a lot of this to? I would wager to say that right now the Federal Reserve is the most powerful person in the country. And before I read some of this quote, I want you to look at the date, June 4th. When we were together in January, we talked about the big steep decline in the market in December and the Fed riding in on the white horse in January and deciding to no longer raise rates. We had a 5% correction in May, on June 4th, from the Federal Reserve. We are closely monitoring the implications of trade developments for the U.S. economic outlook, and as always, we will act as appropriate to sustain the expansion. What did he just say? I'm going to cut rates. When this quote came out, that's exactly what the market read. The Fed's going to cut rates. And we were right back off to the races from the lows that we saw in May, erased all those losses throughout the month of June and on to new highs in early July. What about the Fed? Are they also sure about what they're doing? Is this the right time to cut rates? Should they be raising? The Fed is actually very divided. Of the members of the Fed, 8 members of the Fed say rates are going to remain the same for the rest of 2019. Another 8 members of the Fed said, we're going to cut rates in 2019. And you got one lonely member who says, we're going to actually raise rates in 2019. Well, the real funny part about this is that pretty much all of them agree they're going to cut rates multiple times in 2020. Excuse me? In December, they changed their mind in January, and in January, they changed their mind again in June, yet they know what they're going to do in 2020. This is really important, though, because the market is pricing in those expectations as we speak. So what they say really does matter. And why does the Fed lower interest rates? The Fed cuts rates to stimulate the economy. It will typically stimulate borrowing. It will stimulate spending. It will stimulate hiring. It's going to do all of those things. Well, need I tell you that we're at 3.5% unemployment? Most people are feeling pretty good right now. So the question is, when you cut rates at this time in the cycle, what will the implications be? Will it be the same thing that we got early on, or should we expect something different? And typically, when you get that type of activity, it's to boost up inflation and get a little bit of inflation in the system. Inflation's been running 2%. A lot of people are convinced, inflation is something we don't need to worry about any longer. But possibly that could be a problem. There is already inflation in in many parts of the world today. They've got 17% inflation in Turkey, 37% inflation in Iran. And look at Venezuela. You want to buy a 2-pound bag of pasta in Venezuela? It'll cost you the equivalent of $300 US. There was a report recently released that said for a Venezuelan making minimum wage, it would cost them a month's worth of earnings to buy a package of flour, a package of pasta, and a package of powdered milk. A month worth of wages. Now, it's hard to believe that prices would escalate this fast, but I want to bring you back just a little bit. In 1981, 30-year mortgage rates in this country were 18.5%. Do you think anybody in 1981 had any idea that we'd be seeing mortgage rates at 3%? Again, that ability to look forward and understand the implications of policy and psychology and how people react has a significant impact on the results that we see. Ben Levittson, talked about the stock market, and he put it really simply. Stock market is simply a math formula. And it's how much are investors willing to pay for $1 of earnings. You can see that nice chart. We've had nice increasing earnings. And we just started earnings season. We had a couple of companies reporting here in the last couple of days. And we're already starting to see some pretty positive results. But the problem is, they won't go up forever. And investors are willing to pay more for earnings that is growing quickly than earnings that are growing more slowly than they were the year before. So although we're continuing to see earnings growth, the rate of growth is decelerating. So when you start to apply that math of how much are investors willing to pay for that $1 of earnings, it is going to become more and more challenging to see this market continue to trade at higher levels. So where are we today? 2019 marked really a year of many milestones. And everything from the 75th anniversary of D-Day, the 55th anniversary of the Civil Rights Act, 50th anniversary of Neil Armstrong, and for those of you who are movie buffs or music buffs, 10th anniversary of Avatar, and 20th anniversary of La Vida Loca. Also marked the 10th anniversary of this expansion, now the longest expansion in history. This expansion, though, has looked unlike many in the past. And I call this my mountain chart. But unfortunately, those mountain peaks aren't very high. That top line there is at 2%, and this is a chart of GDP. And every time we start to see GDP accelerate and the economy really start to take on some strength, it only gets followed by a slowdown. And this expansion has been marked by one of the slowest growth economies that we've ever seen coming out of a recession. There are continued signs that the economy is continuing to slow down. And you can see it everything from fewer jobs. We had a weak employment report in May, followed by a strong employment report in June. So maybe the jobs market is still okay. We see weak numbers out of the manufacturing sector. Well, we can attribute that to trade. And possibly if trade is resolved, the manufacturing numbers will improve again. So maybe that's not something that we really need to worry about. Slower economic growth. Well, we've been growing slower. So is 2% growth the end of the world? Does it mean that we're going to continue to decline? Or is it just going to be a slow growth recovery from here forward? And quit rates are level. What are quit rates? Quit rates are the number of people who voluntarily leave their job seeking another one. And it's really unusual that we see quit rates leveled off there are actually more jobs available in this country today than there are unemployed people. So there are signs of weakness, but there's nothing conclusive out there to say, yes, in fact, this economy is heading into a recession anytime soon. Tariffs. It's probably the #1 headline that we deal with on a regular basis. There was even a tweet from President Trump today about trade with China. This is our major trading partners ranked by the amount of exports. And you can see those big ones, 1, 2, and 3, Mexico, Canada, and China. The overhang of tariffs is certainly having a slowing effect on the economy and certainly a difficult issue for companies to deal with. So why are tariffs so significant? Tariffs are a tax. They act as a tax on the cost of those goods. And what a company is going to do? They're going to pass that tax on to the consumer. Consumers, eventually, we get what you call demand destruction. At a certain price point, people will pull back. They'll stop spending. They don't want to buy that product at that price. Once demand slows down, guess what? We need to produce fewer widgets or whatever it is. Well, if we need to produce fewer of them, we can lay off one of the teams on the manufacturing line, right? So we lose jobs. And now you have more people who don't have jobs who can't afford those goods anyway. And you get in this negative feed cycle, and so this higher cost. Tariffs are typically considered to be temporary. They're a lot less temporary right now already. And the longer they last, the longer it will have a big impact on the economy. If the new tariffs are put in, so the average family today, it's estimated it'll cost them $400 because of the increased cost due to tariffs. If the additional tariffs are put in place, that amount will double. This would have a slowing impact on the world economies. And on the US, it's estimated if we go all in with all the tariffs that are threatened right now, it would take away as much as almost 1% from GDP. We're only growing between 1.5% and 2%. If we slow down by 1%, that is not a good economy. And see, the problem is it starts to have an effect already. Boardrooms are sitting around the table today talking about their budgets. Finance committees are talking about what they're willing to spend next year. And if they don't know what's happening with tariffs, they're going to keep their hands in their pockets. And if spending slows down, it will begin to slow the economy, whether tariffs go away or not, because those budgets are beginning to be set for next year. So the psychology of this fact that this is not resolved is already starting to have an impact. The good news is that most economists feel that this is going to be resolved, that as the downside from tariffs to become clearer, the reasons to strike an agreement, however tenuous, will prevail. The market is telling us this, right? The market is saying tariffs are going to go away, we're trading at new all-time highs, this will not be a problem. Now this slide is kind of interesting, because I can sit here and tell you that the markets don't like tariffs, yet we're trading at all-time highs. And it's certain announcements, and again, at the headline announcement, you start to see the market make certain changes. So number 4 right there in the middle, that was the announcement of $200 billion in US tariffs and $60 billion in China tariffs, market headed south. Peg number 5, that was the truce between the US and China, market headed back up. Peg number 6, the threat of more tariffs. So this is going to continue to plague the market as long as it goes on. This starts to affect investor confidence. You can see the significant drop-off from December into January. After the 10% correction that we had, consumer confidence fell through the floor. Since the Fed has stepped in, we've continued to see decent economic data. Consumer confidence has continued to recover. We're still not back to the levels of where we were a year ago, though. So where are we going from here? Well, Technology is going to be the center of a lot of things that we're going to be talking about. And there are, I don't need to mention them today, but there are major retailers working on the ability to make sure your products are delivered to your backyard via drone as soon as the FAA approves it. There are companies today that are delivering medications and supplies to remote parts of the world via drones. The technology is there, it's just a matter of time of when it gets unleashed. How about your data? You know, we had Facebook today testifying about their new currency that they would like to float, and which is a whole nother topic, but the protection of your data, who owns it, who controls it, who's in charge of it, who protects it, this will be a major topic of debate. The big tech companies are under siege right now about this. There is legislation pending that says they want the consumer to own and control all of their data. But it's just not that simple. Think about farmers today. Farmers have technology. There's smart tractors and smart combines using GPS, telling the farmers how to get the best yield for which sections of their crop. Big agricultural company comes along and says, send me that data, I'll tell you what tools and resources and how to get the absolute maximum profit off of your land. Now they've got the data. Who should benefit from it? The farmer or the agricultural company? Nobody knows the answer. This will be pervasive in conversations for a long time to come. And the technology is absolutely scaring. There was an article in Wired magazine that said that there are apps on our phones that are listening to your television. That if you have that app open, it's listening to your television, it knows what you're watching and what you're doing. And if you have any gamers in your home, guess what? That video can be on all the time. It's watching you, it knows what you're doing, it's watching your emotion and how you react to things. And I'm betting a lot of you have some Alexa-type product in your home. Well, if it knows how to respond when you say Alexa or whatever type of device that you have, it must be listening all the time. Who's listening to all of that? Who controls all that information? Whose responsibility is it? This will be a major, major issue for markets and companies and consumers to tackle in the coming years. Clean energy. And I bring this up because of innovation. So there's a scientist out of UCLA who has actually figured out how to create electricity out of snow. And they're looking for the ability to create solar panels for the Northeast that would utilize the sun during the summer months, and it would actually utilize the snow during the winter months. Just incredibly fascinating. When the economy is good and people are feeling good, there's excess dollars out there for research, it creates jobs, it creates new industries, it creates new products, and it's really great for the economy. But even as good as innovation is, we are still worried in our country that we are going to be plagued by very slow growth for a very long time to come. That this is the estimate that all the way out until 2029 that we're going to be sitting again in this slow growth world that we are today. And why? Number one reason, aging population. It's expected by 2040 that 1 in 5 of us will be 65 or older. And by 2060, 1 in 4 of us will be over the age of 65. And why is this important? During our ages from 25 to 49, we earn more than we consume. The younger and the older consume more than they earn. So as that massive part of the population retires and lives much longer than ever anticipated, how will all these social systems be able to keep up, such as Social Security and Medicare and all of those things? It will be a difficult and very tricky situation for Congress and the government to figure out how to make policy that's going to live in a world where we've got that much of the population that is retired. Economists rarely agree on anything, but there's two things that they agree on. Number one, no major legislation is happening anytime soon. In this part of the cycle, we're not going to see any major legislative action. And for a lot of people, that's great. We don't need any new legislation. Just leave things alone, let it be, and we don't need anything. We have to worry about the global problems that we have around the world. And so when we look at the things we haven't even talked about, problems in Europe, Gulf tensions, all of those other things that are out there that are problematic to the economy. And one of the things that that economists do agree on is the fact that they will suspend the budget ceiling and allow that to float up and suspend budget caps. The amount of debt in this country is going to be difficult to be able to service, and it's the other thing that will continue to make the economy slow down. Think about the amount of debt. We're over $20 trillion in debt. Debt service alone, the amount that costs is money that is taken away from productive programs. Will continue to have a slowing impact on the economy. We got to worry about all those things, but remember what we talked about from the JP Morgan. Panic. In periods of time like this, we have to make sure that we are staying the course, continue to focus on the long term, and not let some of the short-term headlines that will continue to come out and plague this market, not allow those things to take you off course. The IMF and the World Bank both agree that growth is going to remain at only about 2.6%. Although they both come from a different place, they're assuming only about a 2.6% growth rate going forward. So what do some of the experts feel? According to Jamie Dimon of JP Morgan, CEO plans for hiring and capital investment remain healthy, but uncertainty about US trade policy, softening global growth condition, and inaction on other pressing public policy issues are a concern. And so again, getting to the point that I mentioned earlier, that as board members sit around and they talk about the future, that uncertainty is starting to affect corporate decision making. And from Liz Ann Saunders from Schwab, and I think this statement says so much about how the markets are reacting right now. Aside from ongoing trade war uncertainty, our other concern is the possibility that the market has gotten ahead of the Fed, with the Fed funds future now discounting more than 100 basis points of easing by the end of next year. Equities may be at risk that the economy supports that much easing. Now, what does that mean? You know, I talk about this often with clients, that we've seen the Federal Reserve say that they're going to cut rates because the economy is slowing down and the market rallies. Does that really make sense? If the economy is slowing down, should the market be rallying? And so if the economy is really slowing down and the Fed has to cut by that much, investors might be disappointed about the economy that we're actually in. So that's one potential problem. The other side is we're also at risk if the Fed underdelivers. So we're expecting that they're going to cut. We're expecting multiple cuts. Will we, in fact, get them? The markets priced them in. So either the cutting is necessary, and that means the economy is not that great, or the Fed doesn't give us what we thought, and the market has this priced all wrong. Certainly two risks to the market right now. And Brian Moynihan of Bank of America says, yeah, we're in this slow growth, and we're going to be kind of like this turtle, but we're not heading into a recession. That we're just going to be kind of staying in this slow growth type of environment. So as we move into the second half of 2019, I think it's important to keep a number of things in mind. Number one, there's been a lot of surprises in the last 6 months. Who would have thought when we were together in January that just 6 months later we'd be sitting at record highs? I don't see any reason why we won't see some surprises coming down the pike in the second half of 2019 as well. And especially when we talked about this evening, consensus thinking is tariffs will be resolved, trade will be resolved. That is baked in. We're assuming that the Fed is going to cut rates, and they will cut rates multiple times in order to continue to support this expansion. That is baked in. That news is already priced into these markets today. So we are definitely subject to a lot of headline risk that these things don't come in a timely manner, or that they don't come within the amount of expectation that the market has already decided how things are going to play out. So certainly sets us up for some volatility, and that's why we spoke about, staying invested during these periods of time. Brian has recently completed his capital markets outlook for the second half of this year. And based on his analysis, he really feels that the lion's share of the returns for 2019 are in the books right now. It doesn't mean that the market can't keep going up. It's a good likelihood, especially if you have a good, strong earnings season, that this market can continue to make new highs. But how much we really progress by the end of the year is highly questionable, given how much has already been priced into the market today. So what we say is our investment philosophy is going to be based on that thought process, and that we're going to work hard every day to protect the returns that we've got on the books for you guys so far this year. So that being said, have a wonderful evening. We hope you enjoyed tonight, and most importantly, enjoy the rest of your summer. This is just such an amazing time of year. Thank you.